Exchange-traded funds, or ETFs, are often considered relatively safe investments for various reasons. Many investors, including myself, have their money invested in ETFs, and it's no joke. What makes ETFs so attractive is due to many reasons, but in this video, we will discuss why ETFs are safe options to park your money. Number 1. Diversification. ETFs typically hold a basket of securities, such as stocks, bonds, or other assets. This diversification helps spread risk across multiple investments, reducing the impact of poor performance from any single security. Diversification can be an effective risk management strategy, making ETFs less vulnerable to the fluctuations of individual stocks. Diversification is a risk management strategy that involves spreading investments across different assets or asset classes to reduce the impact of poor performance from any single investment. In the context of ETFs, diversification is a key factor contributing to their perceived safety. When you invest in an ETF, you are essentially buying shares of a fund that holds a diversified portfolio of assets. This portfolio can include a variety of securities, such as stocks, bonds, or even commodities, depending on the type of ETF. The idea behind diversification is that different assets may respond differently to market conditions. For example, when stocks are performing poorly, bonds may be doing well, and vice versa. Here's how diversification works within an ETF. Spread of risk. When you invest in an ETF, you are essentially buying a share of a fund that holds a diverse portfolio of assets. This portfolio can consist of various individual securities such as stocks or bonds and often aims to represent a specific market index or sector. The spread of risk within an ETF is achieved through the inclusion of multiple assets. ETFs are designed to track a specific index or market segment. An ETF might track the S&P 500 index, which is the 500 large-cap US stocks. By holding shares in this ETF, you gain exposure to the performance of all 500 stocks, which can vary across industries and sectors. ETF tracking the technology sector might include stocks from companies involved in software, hardware, and semiconductor industries. If one sector faces challenges, the performance of other sectors may help offset potential losses. Some ETFs provide exposure to assets across different regions or countries. This geographic diversification can be crucial in mitigating risks associated with economic or geopolitical events specific to one country. Individual stocks within an ETF represent different companies. By holding a basket of stocks, the ETF reduces the impact of poor performance from any single company. Some ETFs employ specific asset allocation strategies, such as balancing between stocks and bonds. This further diversifies the risk, as the performance of stocks and bonds may not always move in the same direction. This diversification strategy aims to provide a more stable overall return for investors. In essence, the spread of risk in ETFs comes from the intentional diversification of assets within the fund. This diversification is a key feature that helps investors manage risk by avoiding over-reliance on the performance of any single security, sector, or geographic region. Reduced volatility. The diversification of assets within an ETF allows for a balance between positive and negative movements in different securities. Individual stocks or bonds may experience price fluctuations due to company-specific news or economic conditions. By holding a mix of assets, an ETF aims to smooth out the impact of these individual movements, resulting in a more stable overall return. The correlation between different assets in the ETF is a crucial factor. If the assets have low or negative correlations, it means they don't move in sync with each other. Many ETFs track market-weighted indices, where the weight of each component is based on its market capitalization. This means larger companies have a higher impact on the index's performance. As these indices automatically adjust to market changes, the ETF reflects more stability. ETFs that follow specific asset allocation strategies, such as holding a mix of stocks and bonds, can benefit from the differing risk profiles of these assets. Stocks tend to be more volatile, while bonds are often considered more stable. The combination helps reduce the overall volatility of the ETF, especially during market downturns. The liquidity of ETFs facilitated by market makers contributes to reduced volatility. Market makers continuously quote buy and sell prices for ETF shares, ensuring that investors can trade at fair and efficient prices. This liquidity helps prevent extreme price fluctuations, as there is a continuous market for buying and selling ETF shares. Reduced volatility in ETFs is achieved through diversification, spreading investments across various assets, and employing risk management strategies, aiming to offer investors a more stable option than individual stocks. Though it's crucial to note that while diversification mitigates risks, it doesn't eliminate it entirely, and market conditions can still impact overall performance. Market exposure. Many ETFs are designed to track specific market indices, which are representative of a particular market segment, sector, or asset class. For example, an ETF may track the S&P 500, a well-known index comprising large-cap US stocks. By investing in such an ETF, investors gain exposure to the performance of the entire index. ETFs often provide broad diversification by holding a representative sample of the securities included in the tracked index. This diversification ensures that investors have exposure to a wide range of companies or assets within a particular market or sector. It's a way for investors to participate in the overall growth or decline of that segment of the market. ETFs exist for various market segments, including specific sectors. For example, technology, healthcare, and energy, regions such as emerging markets and developed markets, or asset classes such as bonds and commodities. This allows investors to tailor their portfolios to specific market exposures based on their investment objectives and views on different sectors or regions. ETFs often follow a passive investment strategy, meaning they aim to replicate the performance of an underlying index rather than actively selecting individual securities. This passivity contributes to a transparent and rules-based approach, providing investors with a straightforward way to gain exposure to the overall market or specific segments. ETFs trade on stock exchanges like individual stocks, providing investors with easy and efficient access to various markets. This market accessibility allows investors to implement investment strategies in real time, buying or selling ETF shares during market hours at market prices. Number 2, liquidity. Liquidity is a crucial aspect of any financial instrument, representing its ability to be bought or sold in the market without significantly affecting its price. In the case of exchange-traded funds, ETFs, liquidity is a fundamental characteristic that contributes to their appeal among investors. One of the key features that sets ETFs apart is their ability to be traded on stock exchanges throughout the trading day. Unlike traditional mutual funds, which are transacted at the end of the trading day at the net asset value, or NAV price, ETFs can be bought and sold at market prices during market hours. This intraday trading capability provides investors with greater flexibility and the ability to react to market conditions in real time. Moreover, liquidity in ETFs is facilitated by market makers, financial institutions, or specialized firms that participate in the market by quoting bid and ask prices for ETF shares. Market makers play a crucial role in maintaining a liquid market for ETFs by ensuring that there are continuously available buyers and sellers. Authorized participants, or APs, typically large institutional investors, can create or redeem ETF shares directly with the fund. When there is increased demand for the ETF, APs can create new shares by delivering a basket of the underlying securities to the fund. Conversely, when there is excess supply, APs can redeem shares in exchange for the underlying securities. This process helps keep the ETF's market price in line with its net asset value. The bid-ask spread is a measure of cost of executing trade in the ETF market. It represents the difference between the highest price a buyer is willing to pay, bid, and the lowest price a seller is willing to accept, the ask price. ETFs generally have narrower bid-ask spreads compared to less liquid securities, making them cost-effective to trade. The presence of market makers contributes to the tightness of these spreads. Furthermore, ETFs trade on the secondary market where investors buy and sell existing shares from other investors. The secondary market liquidity is influenced by the trading activity of the market participants. High trading volumes and a robust market-making ecosystem contribute to a more liquid secondary market for ETFs. The liquidity of ETFs is further enhanced by the arbitrage opportunities available to institutional investors. Through arbitrage, these investors can exploit price discrepancies between the ETF's market price and its NAV. When the market price deviates from the net asset value, arbitrageurs can step in to buy or sell the ETF shares and in the process help align the prices. ETFs cover a wide range of asset classes, including stocks, bonds, commodities, and more. This diversity allows investors to access different markets and sectors while benefiting from the liquidity associated with the ETF structure. Whether an investor is interested in equities, fixed income, or niche sectors, there's likely an ETF available with sufficient liquidity. Lastly, ETF shares are typically created and redeemed in large blocks known as creation units. These creation units are multiples of the standard ETF share size and usually consist of a basket of the underlying securities. The creation unit mechanism helps facilitate the efficient creation and redemption process, contributing to overall ETF liquidity. Before we continue, please hit the like button and share this video for fun. Number 3. Transparency. Transparency is a key characteristic of ETFs that sets them apart from some other investment vehicles. In the context of ETFs, transparency refers to the openness and accessibility of information related to the fund's holdings, structure, and operations. One of the primary aspects of transparency in ETFs is the requirement to disclose the fund's holdings on a daily basis. This means that investors can access detailed information about the individual securities or assets held by the ETF every trading day. This level of transparency allows investors to understand the composition of the portfolio, including the names, quantities, and weights of the securities held. Many ETFs transparently track specific indices, providing publicly available rules for index construction, ensuring investors understand performance measurement. Detailed information on portfolio composition, including sector allocation and geographic exposures, allows investors to align the ETF with their overall investment strategy. The transparent creation and redemption process involving authorized participants, or APs, contributes to price transparency by closely aligning market price with net asset value. Overall, these elements underscore the transparency of ETFs, promoting informed and strategic investment decisions. ETFs disclose their expense ratios and fees, providing investors with a clear understanding of the costs associated with holding the fund. This transparency allows investors to compare the cost structures of different ETFs and make informed decisions based on their preferences and cost considerations. ETFs are required to provide regular reports to investors, including prospectuses, annual reports, and semi-annual reports. These documents contain comprehensive information about the fund's objectives, risks, performance, and financial statements. The availability of such reports ensures ongoing transparency and helps investors stay informed about the fund's activities. The information related to ETFs is generally accessible to the public through various channels, including the fund's website, financial news outlets, and regulatory filings. This accessibility ensures that investors, regulators, and other stakeholders have the information they need to access the ETF's characteristics and performance. Number 4, lower costs. The lower costs associated with ETFs are a result of their passive investment approach, operational efficiency, and unique structure. For instance, many ETFs follow a passive investment strategy, aiming to replicate the performance of a specific benchmark index rather than actively selecting individual securities. This passive approach eliminates the needs for active management, reducing the associated costs such as research analysis and decision making. As a result, ETFs can offer cost savings to investors compared to actively managed funds that involve higher management fees. The expense ratio is a key metric that represents the annual operating expenses of an ETF as a percentage of its average net assets. ETFs generally have lower expense ratios compared to actively managed funds. This is because the management of passive ETFs involves less intensive research and trading activity. Investors benefit from cost efficiency as a significant portion of the fund's asset is typically invested in a broad basket of securities mirroring the index it tracks. ETFs are structured in a way that promotes operational efficiency. The in-kind creation and redemption process involving the exchange of securities between the ETF and authorized participants helps minimize trading costs. This process also reduces the need of frequent buying and selling of securities in the market, which can contribute to lower transaction costs compared to other investment structures. Unlike some mutual funds that may charge front-end loads, fees when purchasing shares, or back-end loads, fees when selling shares, ETFs typically do not have these types of sales charges. Investors can buy and sell ETF shares on the secondary market at market prices, incurring standard brokerage commissions. This fee structure enhances cost effectiveness for investors, especially those who engage in frequent trading. ETFs often exhibit tax efficiency, which can contribute to lower overall costs for investors. The in-kind creation and redemption process, along with the structure of ETFs, helps minimize capital gains distributions, compared to mutual funds, which may distribute capital gains to shareholders when the fund manager sells securities at a point. ETFs can offer tax advantages by deferring capital gains realization until an investor sells their ETF shares. The growing popularity of ETFs and increased competition among ETF providers have led to a fee war in the industry. Providers strive to attract investors by offering low-cost options to remain competitive. This competition benefits investors as they can choose from a variety of ETFs with different investment objectives and risk profiles, all while enjoying the potential cost savings associated with lower expense ratios. Many ETFs do not have minimum investment requirements, allowing investors to start with relatively small amounts. This accessibility eliminates barriers for smaller investors who may find it challenging to meet the minimum investment thresholds required by certain mutual funds or other investment vehicles. Number 5, intraday trading. Unlike traditional mutual funds, which are priced and traded at the end of the trading day, ETFs provide investors with the flexibility of intraday trading on stock exchanges. ETFs are traded on stock exchanges just like individual stocks. This means that investors can buy or sell ETF shares at prevailing market prices throughout the trading day. The continuous market access is a significant advantage for investors who want to react to market news, economic events, or changes in their investment outlook during market hours. Intraday trading in ETFs offers investors a high level of flexibility and control over their investment decisions. If an investor perceives an opportunity or a need to adjust their portfolio based on intraday market developments, they can execute trades promptly. This flexibility contrasts with traditional mutual funds, where investors place orders to buy or sell at the next calculated net asset value at the end of the day. Real-time execution can be crucial for investors who want to capitalize on short-term market movements, hedge against risks, or implement tactical trading strategies. The ability to trade ETFs intraday provides investors with additional tools for risk management. If market conditions change rapidly or if there's a need to adjust exposure quickly, investors can react promptly by buying or selling ETF shares. To conclude, while ETFs offer various advantages, it's important to note that all investments carry some level of risk, and past performance is not indicative of future results. Investors should carefully consider their investment objectives, risk tolerance, and conduct thorough research before making investment decisions.